So all students came? Very good. Okay, let's start. Hello, welcome to Commerce Hub by Monomasa classes, and I am your Monomasa. Today's our topic is based on class 11 commerce, and it is accountancy. Now, today's topic, accounting principles. This is very important topic for your exams, right? So before starting our video, please like, share and subscribe our channel. So today's our topic is accounting principles. What is accounting principles? Accounting principles are the uniform set of rules or guidelines which are generally accepted by all the accountants while doing accounting works, and they are together called GAAP, full from generally accepted accounting principles. And these principles are very important because the whole world is following the same principles while they are doing accounting works. So let's come together. Accounting principles. So accounting principles have two parts. One is accounting concepts or basic assumptions, and the second one is accounting conventions. Now, which is very important, it is those accounting concepts or assumptions. So see, what is accounting concepts or assumptions? Actually, whenever we are doing recording, classifying, summarizing the work of accounting, we have to based on certain assumption, because without assumption we can't come to a particular result. That accounting assumptions or that concepts are called accounting concept or accounting basic assumption, and those things which is helpful in making final result, that means they are also assumptions, but here their work is only a particular area, and particular area is maintaining systematic record, or we can say making profit and loss account and balance sheet, that means for making final result, and that is called accounting convention. Okay, so let's come start with the accounting concepts. First one is going concern concept. What is going concern concept? Suppose you think, if Tata company thought that we will run our business for only 10 years, that is not possible to survive now, right? Now Tata company has become a very large company and it is more than 10 years. So that means they are following the going concern concept. As per going concern concept, the firm or the business is estimating that we will run, or the firm will run over a long period of time, and it will never end in known future. That means we know the future. We don't know the future. It might be infinity, whatever. That means the firm will run like this. That means it will run over a long period of time. Okay. So that is going concern concept. Now come to consistency concept. What is consistency? You must be consistent. That means you have to stay on a particular method which you are following. As per consistency concept, those methods we are following, you have to maintain that method, or you have to do accounting work based on that method year by year. You can't change it. That is called consistency concept. Now come to the accrual concept. What is accrual concept? Can you tell me, anyone? Yes? Yes, right answer. Okay, so accrual concept. What is accrual concept? Accrual concept means whenever any sales or revenue will occur, that time only profit will occur. That means in a business which is a FMCG or which is a production firm, in case of production firm, their main revenue will come from what? By selling the goods. That means whenever you are selling the goods, you will get profit. Otherwise, no chance to get profit. According to accrual concept, revenue will only come whenever sales will be made. Otherwise, it will not come. It might be on credit, it might be on cash, but it will be on that particular accounting period. Okay, so that is accrual concept. Now business entity concept. What is business entity concept? Students, business entity concept is that concept which shows that the owner or the proprietor is not the business. Yes, actually, in the ancient time, it was the thought of the accountant that business and owners are same person. But nowadays, the scenario is completely changed. Now, business is a separate legal entity. Business loss is only business loss, not the owner's loss. So, according to this concept, business has a separate entity from its owners. Okay, so now come to the next concept, that is called money measurement concept. I think you all know what is money measurement concept. Yes, say right answer. According to money measurement concept, only those things we will measure which is come or which is measurable in terms of money. That means in accounting transactions, only those things we will take into consideration which is measurable in terms of money, or which we can say economic transactions. Other transactions we will not record in the books of accounts. Okay, now come to the next concept, which is called accounting period concept. What is accounting period concept? Actually, this concept is coming from the first concept, that is going concern concept. See, according to going concern concept, if we think that our firm will run over a long period of time, and as per accounting, at the end of a particular period, we are doing profit and loss account and balance sheet. For what? For making the final result. Now see, if we think that our firm will run over a long period of time, that means when the firm will dissolve after 10 years or after 20 years, that time we will maintain the profit, that time we will collect all the data, but it is not possible to anyone. It is not possible to anyone to measure a whole 10 years data at a time. That's why this accounting period concept arrived. According to this concept, the whole life of the business is divided in 12-month period. That is starting from 1st April and it is closed on 31st March of the corresponding year. And this particular period is called accounting period. Okay. So next concept, cost concept or historical cost concept. What is historical cost concept? Yes, it is come from history. No, actually not like that. Actually, historical cost concept says that whenever you are purchasing any commodity or whenever you are purchasing a particular fixed asset, say you are purchasing a furniture worth rupees 10,000 on in the year 2002, but now the current price in the market of that furniture is maybe 1 lakh, but you will measure the furniture in which you have purchased it. That means according to historical cost concept, the business will consider all the asset at their cost price or as their collected price, not in the present market price. Okay, now come to the point, next concept, which is called dual aspect concept. Dual aspect concept, what does it mean? It means that every transaction occur, it must affect at least two accounts, and in case of accounts we know that one part is debit and one part is called credit. Yes, that means as per dual aspect concept, every transaction must affect at least two accounts. One account is called debit, another account is called credit. Next one, revenue recognition concept or realization concept. Now what is revenue recognition concept? Revenue recognition, yeah. Actually, as per revenue recognition concept, revenue will consider in that period in which it is actually realized or in which it is actually collected. That means we can't assume any deemed revenue. Yes, only those revenue we will consider in the books of accounts which is measured or which is done in that particular at that particular accounting year, right? Yes. Now next one, matching concept. What is matching concept? Can you tell me? Anyone, students? Yeah, Raj, you say? Yes. No, 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 no. Actually, as per matching concept, it is assumed that the amount of debit side must be matched with the amount of credit side. That means, as per matching concept, both side of the journal, or we can say both the account which is affected by a transaction, must be equal to each other. You can't say that debit is rupees 10,000 and credit is rupees 5,000. It is not possible. Every time both the account will be same. Okay, that is called matching concept. The last one, objectivity concept. This concept, according to this concept, it is assumed that the only those transactions or only those things we will consider which is a part of our objective, main objective. That means the immaterial or any other thing is like we can say unseen that will not come in the books of accounts. Only those things which is based on our objective, that will only come in our accounting. Okay, so these all are the accounting concept. Okay, now come to the point, accounting convention. So I told you earlier, accounting convention will only come when we are making final account or when we are making a financial statement, right? The first one is convention of full disclosure. Full disclosure, that means whenever you are showing the final account or we are showing the data of a particular organization, you never hide a single data. You have to fully disclose all the transactions which will affect the financial position of the business or which will affect the profit. So every transaction, it must be fully disclosed in the books of account. No hidden charges or no hidden adjustment will be there. Okay. Second one is convention of materiality. Convention of materiality shows that only those things we will consider which is material for our business or which is material for making profit and the financial position of the company. No immaterial things we will consider in the books of accounts. Okay. And the last one is convention of conservatism. What is convention of conservatism? Somewhere it is called prudence. Convention of prudence also. Actually, business is full of risk. We know that. Whenever any businessman is doing business, he is taking the risk. And profit is the reward of taking the risk. Yes, profit is the reward of taking the risk. But as per convention of conservatism, it is assumed that the business will take less risks while doing the business or while doing its work. That means this assumption assume that or this assumption says that you must take minimum risk while you are doing your accounting works. For example, suppose in that case we will consider all probable losses priorly. That means probable losses you have to consider, but probable gain you will not consider. Okay, in this way you can make yourself less riskier. Okay, for an example, those things, suppose you are giving money to any of your friend and you are thinking that it might be a bad debt. In that case, you make provision for bad debt for it, right? That means you taking the provision. So while you get the bad debt, that means that amount will not receive by you. Okay, don't worry, because I already kept that particular amount. But no probable income you will write in the books of accounts. Okay, so this all the things we discussed today. Actually, I forget to say that this all the things, all the principles is given by or issued by ICAI. The full form of ICAI, I think you all know. That is Institute of Chartered Accountants of India. And as per accounting standard 1, all the principles is coming here. Okay, accounting concept, accounting convention is based on accounting standard 1, which is issued by Institute of Chartered Accountants of India. So that's all about today's video. Please like, share and subscribe, and don't forget to comment. Okay, thank you students. Bye bye, take care.